My name is Gareth Kelly. I'm an Associate Director and Financial Controller here in O'Dwyer's. I'm delighted you could join us today for our monthly OMC Client Information Seminar. Today's seminar is entitled Insurance in Muds. It's a very interesting topic, and I'm sure, like me, you're looking forward to hearing more on this area. Our talk today has been given by Henry Sludds of Wills Risk Services. Henry is ACII qualified and corporate insurance broker and senior account executive with over 15 years of experience in insurance broking and consultancy. Henry's responsibilities include the day-to-day management of Willis's apartment block team, as well as providing advice on scope of cover and claims. Henry works on strategically managing client insurance and risk management of portfolios to a broad spectrum of clients. So I think Henry's presentation today will be approximately half an hour, and we'll have time for questions afterwards. So I just want to welcome Henry.
Many thanks.
Thank you.
Thank you very much. That's correct. Thank you everybody for attending during your lunch hour and also during the inclement weather. The aim of this seminar really is to give an understanding of some of the risks that owner management companies face and what insurance covers are available to protect the owner management companies against these risks. Just before we start, I would like to say that this presentation is intended to be an overview on this topic. It should be used as a general guide and not a substitute for professional advice. If you require detailed advice, you should contact your insurance brokers or, in fact, contact myself, Henry Sludds. We will discuss, I suppose, the various risks faced by multi-unit developments and also give an overview of the current insurance market conditions and what steps owner management companies can implement in order to control their insurance premiums. Generally speaking, there are three broad categories of risks that each management company faces. It could be, defined within three headings rather than six. It's usually assets, income and liability. And what we want to arrange is the insurance for financial protection against losses arising from the various categories. Most of these risks could really be catered for under one block policy, with the exception of engineering and directors' liability insurance. The block insurance is one of the many things that service charges pay for. It's an insurance policy taken out by the management company. It covers all common areas, buildings, grounds, car parks, lifts, etc. It's a condition of most people's mortgages, so it's not optional that this insurance cover is in place. And in the current climate, it's also likely to be a sizable chunk of the total running costs of developments each year. So it's vital that the boards are well informed when choosing an insurance policy. What is insured under a block insurance policy? Just to go through it section by section. Under the property damage section of an insurance policy, it generally includes buildings and contents. These will be buildings for the block of apartments, outbuildings, fixtures and fittings, swimming pools, tennis courts, pools, etc. It can also be extended to include duplexes and private dwelling houses, depending on whether or not they're the responsibility of the owner management company. Ideally, as to whether they're freehold or leasehold will determine whether they should be included within the programme or not. Policy should generally include contents within the common areas. The standard limit provided by most insurers is $25,000 per block, and it includes cover for furniture or other property in common areas for which the management company are legally responsible for. It does not include individual contents. Any individual's own contents, be they a landlord or a tenant, must be covered under their own arrangements. What are we covering buildings and contents against? We're covering against loss or damage arising from fire, lightning, explosion, aircraft, riot and civil commotion, malicious damage, storm, flood, escape of water, etc. These will be the standard perils provided by most insurance policies. The standard exclusions by a number of insurers would include wear and tear, gradual deterioration, faulty design, corrosion, frost, breakdown, terrorism, asbestos. What I would say is that different insurers or underwriters provide different exclusions, and they should be reviewed with your broker or property manager to ensure that the owner management company and that the board are fully aware of the implications of these exclusions. For example, wear and tear and gradual deterioration, some insurers will provide a complete exclusion relating to any damage arising from those items, whereas others will say if a pipe separates or if it bursts or if it wasn't installed correctly, that we won't cover any of the repair work to the actual pipe work itself, but we will provide cover to the consequential damage, being the loss arising from the escape of water, for instance. Standard policy extensions on an apartment block policy would include cover for landscaping costs, fire brigade charges, location of leaks, or alternative accommodation and day one inflation provision. Those amounts are nominal. They do change from insurer to insurer, and if they need to be increased, they should be reviewed. I mean, for example, alternative accommodation and loss of rent, 25% of the building sums insured. It's an interesting topic at the moment, as we're having a number of discussions with insurers as to whether or not that limit is adequate. If you had a large block, and God forbid there was a fire or disaster, and that block had to be evacuated for in excess of 12 months, would 25% of the building sum insured be adequate to rehouse everybody for those 12 months? And would 12 months be an adequate amount of time for repairs to be carried out, or indeed the block to be reinstated? It's certainly worth considering when discussing with your clients. Another thing at the moment that's, I suppose, very in vogue by insurers is various different warranties being imposed, primarily relating to unoccupancy warranties. There are many different conditions to unoccupied apartments or units or substantially unoccupied buildings. These vary hugely from insurer to insurer. Some insurers will take the view that the entire block needs to be unoccupied before they impose any restrictions. Others will say once an apartment or unit is unoccupied for 30 consecutive days, then certain restrictions will apply. Others will say that it's 60 days. It's something that you should, I suppose, inquire from your broker and discuss with the board as well. Warranties relating to the vetting of contractors and insurers. We've had numerous claims whereby various different contractors have been on site in different developments. Accidents have arisen, and unfortunately the contractors didn't have adequate insurance in place. This has implications both for the owner management company as well as, in some cases, the managing agent. The OMCs should ensure that any warranty or restrictive condition or clause in policies is relayed to the various members. There is no point in discussing these at an AGM or a board meeting and then not relaying them to the various members within the development itself. We've had many incidents whereby excesses have been increased, members haven't been informed, and it's caused a lot of problems when claims have arisen. A block policy would generally include employers and public liability insurance for death, injury, disease to any employee in the course of their employment, if there are any employees of the management company itself. And the policy will also include cover for death, injury, disease to anybody else other than an employee. Those are the limits that we would look for. A limit of indemnity of 13 million any one accident for both employers and public liability insurance. Some insurers will offer significantly less. It will be my opinion that they should be at least 13 million for each class of insurance. One of the other classes of insurance, I suppose, that apartment block companies need is engineering insurance. We're often asked as to why engineering insurance is required, because they may have a maintenance company in place. The need for engineering insurance, I suppose, is twofold, and it predominantly applies to passenger lifts within apartment developments. It's a statutory requirement that the block of apartments, that the passenger lifts within the block of apartments are periodically inspected at least every 6 months. And this is under the Safety, Health and Welfare Work Act or Regulations 2007, that these lifts are safe to use. The statutory inspection could be carried out by the management company's lift maintenance firm, but they're not normally able to offer the insurance cover in addition to that. In essence, the inspection should be carried out by a competent person independent of the maintenance contractor. I mean, the aim is to, I suppose, detect any defects that are there or that are dangerous and report them to the duty holder, which in this case is the management company itself, so that remedial action can be taken. One would wonder as to whether there would be a conflict of interest if you were the maintenance company and then were carrying out an audit on yourself. In addition to the policy providing the contract for statutory services and the issue of the reports in compliance with the legislation, it does provide cover for sudden and unforeseen damage to the passenger lift. The management company would still need a maintenance contract for lifts, as the insurance policy wouldn't include routine maintenance or repairs or for wear and tear. Directors and officers of owner management companies should be aware that they can be deemed personally liable for their acts, and without insurance they're effectively risking their own personal wealth and the future of the actual organisation or association, since the financial implications of legal action can be disastrous. Responsibilities for directors and officers of management companies include the need to ensure that the property is safe and that any lifts are inspected to meet the statutory requirements, any contractors carrying out maintenance do so properly, and that the finances are in order so that any resident who could be deemed personally liable for the debts of the company. The law doesn't distinguish between a director of a residents' association or that of a major corporation. Ignorance in law is no defence, so it's important that any resident or anybody who wishes to take that position of responsibility know the liabilities that they face, especially in some cases these liabilities are unlimited. The types of exposures faced by directors and officers of owner management companies include health and safety, for fire safety, electrical and mechanical equipment checks, Insolvency Act, Companies Act, Disability Discrimination Act, dishonesty to fellow employees. I mean, as you can see, there are many different exposures that directors and officers face, and therefore insurance cover is needed to ensure that directors and officers of the OMCs are protected against any claims or allegations made against them. What does directors and officers liability insurance cover? In essence, the policy will provide cover for any awards if indeed the individual or the organisation is found liable. It will also include cover for costs and expenses with the prior agreement to the insurer that are incurred in terms of the investigation, settlement and defence or appeal of any claim. Examples of some of the directors and officers liability claims would include, we've had many different instances, these are only a small selection, but an unruly family bought an apartment block in an otherwise selective block. The owner of the adjacent apartment put her property up for market and alleged that she was forced to sell for less. She sued the chairman and the secretary of the management company on the grounds that they failed to discipline the family who had clearly intimidated them. We've also had incidents whereby a management company was personally held liable for the appointment of a responsible builder to re-roof a large block of apartments. The firm botched the job essentially and went into liquidation, and the work was so poor that it had to be done again and the members had to be levied for the additional monies to be paid out. They in turn took an action against the directors of the owner management company. Residents of an apartment building made a claim against the trustees of the resident association alleging that they'd misused the funds collected from the residents. The residents again said that they had to pay additional money to the association. We've also had incidents whereby accounts hadn't been logged with the CRO in time. As a result, units couldn't be sold, and indeed maybe were sold for a little less, but again various different residents took claims against the directors and officers of the owner management company. We've had a situation whereby a prospective employee, a gardener at an apartment block, made a claim against an individual trustee or member of the board after they were unsuccessful in gaining employment. He alleged that he hadn't been employed because of his race. These are all actual claims and they have been settled. I haven't put the amounts up against them, but one would wonder as to whether you would want to be on the board of an owner management company without having, I suppose, the financial backing in the event that somebody did take a spurious or an actual claim against yourself. Just to give a brief overview of the current market conditions for insurance in relation to apartment blocks. There are probably, 13 to 15 different insurers competing for this business at the moment. Some, I suppose, are more aggressive in terms of wanting to quote for this type of business. Each insurer has their own underwriting criteria. Their policy wordings vary considerably in terms of the restrictive conditions and warranties that they apply. A number of insurers have since withdrawn in the last few years because they've deemed this element or this sector to be unprofitable for them. The reason being is that they feel that the premiums are too low against the claims that they've paid out. There is a variety of policy wordings, all risk, fee, defined perils. It's certainly worth discussing this with your insurance broker as to which is provided. All risks essentially mean that the insurance policy will cover anything and everything other than what is excluded by the policy. Defined perils will only include cover for those defined perils, and they're usually listed down. You should examine the presence of warranties and conditions. What has emanated, I suppose, in recent times is that the lowest common denominator for apartment block insurance has been the premium, and one needs to differentiate, I suppose, the cover being offered versus the price being given. There are often the presence of onerous warranties and conditions which severely limitate the cover, and as a result that's why other insurers can do so cheaply. Claims excesses, this is again something that has emanated, I suppose, in recent years, whereby claims excesses maybe 5 or 6 years ago were probably as low as €250, and now it's not unusual to have claims excess 5,000 upwards. Also, what insurers have done is, in the last 2 to 3 years, particularly due to reoccurring claim problems in connection with water damage claims, they've changed their underwriting methodology, I suppose, in relation to how they approach apartment block insurance. Basically, they've introduced restrictions, particularly in the area of unoccupancy and water damage. They've instructed loss assessors to adopt a tough approach when interpreting the policy wording, to place the onus of proof of loss on the insured, especially in respect of water damage claims. They do try and negotiate the cheapest settlement terms possible, with no flexibility being shown in favour of the insured. The imposition of high, very high, I suppose, claims excesses and policies, I just don't know whether that's the result in terms of keeping premiums at a more consistent level or not, or whether that's just masking an underlying problem as to whether or not an issue needs to be addressed. But there has also been a total change in pricing, particularly for developments who have a high frequency of claims. How can owner management companies control their insurance premiums? These are just 7, I suppose, short steps. One would be that they should reassess the reinstatement value of their development every 3 to 5 years to avoid over-insurance or indeed under-insurance. This would generally cost in or around, I suppose, €1,500 for a large development. It's certainly money well spent. In relation to risk management is the process of identifying those issues which can cause loss of property or injury to employees or member of the public. And it's about putting in mitigating controls in place so as to eliminate their potential or at least minimise their impact. I mean, there's no shortage of scenarios that can arise at a development. An elderly woman slips on a footpath outside a building that you manage, or there's a fire in an apartment complex that burns through several units, or children get sick from an exposure to toxic mould in one of the properties. I mean, the OMC and the property in conjunction with the property manager need to manage these risks, and it might be as simple as, managing risks such as uncollected waste, abandoned cars, or broken emergency light fitting. I mean, the idea being is to try and stop claims happen before they occur. If you have an electrical junk box in the car park, make sure they're locked, and if they're low down, try and surround them with barriers to prevent cars from colliding into them. A robust risk management system will not only reduce the frequency and severity of claims, but they will also provide evidence to the insurance company as to why that particular management company should be accredited with a lower insurance premium. We would also suggest that, owner management companies carry out health and safety audits and fire risk evaluations, test the systems regularly, document your approach to that. I mean, document any attempts to fix problems that have shown up during these audits. Control the claims is probably the biggest thing. Don't treat your insurance policy as an ATM, as this will leave the OMC with a very poor claims history. The resultant defect being is that it will drive up premium in future years. Try and identify if there is a frequency of claims and the actions taken to prevent same. What I would also advise is that the owner management company board should be always aware of the claims history. Each claim should be documented and examined and discussed in conjunction with the property management or property managing agent before being passed. What I would say is that the OMC and the broker and the managing agent should review issues with insurers regularly to try and build a long-term relationship with the underwriter. If they have a good relationship with the insurer and broker, you'll be able to discuss issues and find resolutions. I mean, try and work with the insurer to resolve these problems and demonstrate that you're working to resolve these problems. In relation to your insurance renewals, I would suggest that the best thing to do is engage at an early stage. Presentation and underwriting information is key here. This is where your managing agent comes into its own. I mean, they will be able to advise what improvements and what investments have been made by the OMC over the last 12 months and how to present it in the best possible terms to ensure that you get the most competitive premium and cover available. In relation to the claims process, basically, when we receive a claim notification, underwriters look for as much detail as possible. They will usually look for a loss notification form, which is emailed either to the property manager or ourselves, but in addition they tend to look for images of the damage, a report from a contractor to confirm what the cause of the leak or repair for fire damage, etc. is, as well as what the estimate for repairs is going to be. On receipt of that, they will then determine whether or not they will use the services of a loss adjuster to assist in the repair process. And following that, then they will determine whether or not the policy cover will settle or decline the claim depending on the circumstances of it. The role of an insurance broker is basically to provide independent risk advice, impartial professional advice, and to negotiate the widest possible cover for the OMC. In addition, we would review the insurer's security to ensure that we're not placing cover with an insurer with a, I suppose, questionable financial status. We would also review contracts, vetting of contractors' insurances, claims management, and any other risk or insurance that could be put in place for the owner management company. Whilst in conjunction with O'Dwyer Property Management, obviously we want to ensure that each owner management company keeps their service charges to a minimal, and a professional property manager can do this by using their expertise and buying power to ensure that the best premium and policy cover is available in the market. I appreciate that was very short and sweet, but if there's any questions, I'm happy to take them.
One of the things that is becoming more and more common is the unoccupancy, and you touched on it there a minute ago, and it's having a fairly significant effect on the premium or not being able to provide cover. Is there anything an owner can do to try and reduce the risk from an unoccupied unit if it's a financial institution like a bank or a receiver or something?
Absolutely. I mean, if they could demonstrate that the unit has been secured, that maybe the water service has been turned off, maybe the electrical services have been turned off, it's really a case of how long is that unit likely to be unoccupied, what are their plans for that unit going forward. Each insurer will have their own set of conditions as to how they want that unit secure going forward. They may want letterboxes closed and waste removed and the unit checked every 7 days, every month, or depending on whether there is somebody on site as to whether or not that's possible. The difficulty really is that the owner management company may not be aware that a unit is unoccupied, so it's very difficult for them to take an action in relation to that. I mean, if it were a case that I owned a unit and I decided I was going on holidays for 30 days, unaware that there's a 30-day unoccupancy exclusion, and a leak emanates from my apartment, not only damages my apartment but the unit below, the policy cover may respond to the unit below because it's through no fault of theirs, but may not cover the damage to my unit. I think it's something that needs to be assessed on each insurance policy as to what the implications and steps are for each OMC. Does that answer your question?
Yeah, absolutely. It's how it affects both the owner and the OMC.
The question we're often asked is as to whether or not, I suppose, water damage is as a result of the fault of an owner or tenant, and whether or not the policy should respond in that situation. Really, it's circumstantial or case specific. If it's a case that somebody leaves a tap running and goes to the shops and it flows into the unit below, well, yes, they probably should be held responsible. But if it's a case that there's a gap in their washing machine pipe behind the back of it and they've no way of knowing that that's there and it's been dripping for a number of months, I don't know whether they should be held responsible for that. I've yet to see an insurance company pursue an individual for these type of claims, but that doesn't preclude them from doing so. They're well within their rights, and I would suspect it's only a matter of time before they do.
You mentioned there's more restrictions coming into play at the moment. So what are the kind of most common restrictions that are?
The most common restrictions, I suppose, that we're being made aware of are unoccupancy restrictions, the restrictions in relation to the water damage cover by imposition of large water damage deductibles. There are also different terms and conditions depending on, I suppose, the insurance policy in place in relation to vetting of contractors. They may stipulate that, and a lot of these may be done anyway, but we're not always informed that, say, the drains and gutters are cleaned every 12 months and so on. And there might be a process in place to do that, but there might not be. And these are things that need to be assessed, particularly if you're considering changing from one insurance company to another. That, you know, yes, you might get a cheaper premium, but there might be more obligations imposed, and one needs to be aware as to what exactly they are and whether or not the premium differential is worth changing for.
In some older developments, you'd have basement car parks maybe where water is seeping through and bringing the lime content down, and that hits the cars and will eventually affect paintwork. What's the OMC's insurance policy's liability in relation to a damaged car where water?
Indeed the OMC are deemed liable, the policy should respond. But if it's something that's not fortuitous and they know that this is going to happen, they do need to take some action against it. It's not just something that's going to respond and let the OMC sit on its hands and not take any remedial action. It's not always possible. It might be a difficult solution, but action does need to be taken. Having said that, if they are held legally liable, the policy should respond. Now, we have had issues with some insurance companies, particularly where it's a resident's-owned car, saying, well, in essence, you're part of the OMC and you can't sue yourself. I'd take exception to that personally. I think that depending on the cause as to whether the OMC are liable or whether that own individual is liable. I mean, if you knew there was a drift coming down, you decided to park your car there because it was convenient to go into the building, you would have to bear some contribution towards that loss yourself.
But it was a designated space that you were allocated?
Yeah, I think that the OMC could be held liable and that the policy should respond. That said, I have seen insurers try and decline these claims, and others pay them.
The person's own car insurance pay the...
Generally what happens is the person's own car insurance will get the repairs carried out. They may claim against their motor insurance, but but it usually has an impact in terms of a no claims bonus, and as a result they're reluctant to do so. Plus, I mean, if they're allocated that spot, it should be fit for purpose. So the OMC does have a case to answer, but they need to ensure that the policy responds for that. But in the event of an incident happening there once, if you were to come back to an insurer 2 or 3 times, they probably wouldn't be look on these claims too favourably. I mean, what insurers are looking for more so than ever is more information in relation to the construction and makeup of the building itself. It's obviously very controversial at the moment, the issue in relation to fire stopping, the type of insulation being used in buildings, whether or not buildings are timber framed or are they concrete built, and these things can be awkward to find out once the building is complete without having some, I suppose, investigative or invasive works. But the more information we can provide around that, the better the customised and tailored the insurance policy will be. Some insurance companies do not want to quote for, I suppose, timber frame building, and as we know, a large amount of duplexes built in the last number of years are in fact timber frame buildings. So I think a lot of insurance companies are on the hook for these as they are, without actually knowing what the construction is. But the more information we can get in relation to the construction of a building, the better the insurance solution will be. Another thing, I suppose, is that an insurance company will generally visit a development within the first 12 months of binding cover, or maybe once the policy is being renewed. If you're not upfront in terms of what's present in the building itself, they will impose risk requirements and recommendations, and that might be, you said there was a smoke alarm in each unit, there's not, so now you need to install a fire detection system, which could be considerable cost. And you may have changed from an insurance company for a small saving, and you could end up expending a large amount of money to try and comply with these requirements going forward. They are material facts. If an insurance company does impose, I suppose, a recommendation or requirement, is something that does need to be disclosed to the market. So there's no point saying we'll just ignore what this insurer has said, go to another insurer, won't tell them about it. If in the event that that happens, your claim will be declined. Okay, thank you very much. Any other questions?